Hello, everyone. This is Osama Rizvi from Primary Vision Network, and welcome to another episode of Monday Macro View. Last time we discussed some of the impacts of weather on European continent and the broader energy markets, but this time, given the amount of rosy outlooks and all is going to be good sort of reports out there, I think it's better to give a just look at some of what might come across as a reality check of what's going on. So, if you look at this chart, the global economic growth, this was from IMF, they have slightly increased their out estimates, but still, global economic growth is poised to slow down from 3.4% in 2022 to 2.9% in 2023. That is, of course, a shift down. And then this is where the tricky part is. They expect it to increase to 3.1% in 2024. And we don't know, I mean, whether it's going to be an L-shaped recovery, a U-shaped recovery, a K-shaped recovery, a V-shaped recovery. We don't know. I mean, it's too premature to say that. And of course, they always sort of revise their estimates because, they haven't gotten it right most of the time. Within this, you see that India and China are the major drivers of growth. And it's very interesting recently that data from oil markets came up and Asia was in the driving seat when it came to oil demand. However, it wasn't China that was calling the shots, it was India and it was South Korea, it was Singapore, other countries. So, on another side, on another domain, we also need to look at what's going on individually within these countries. But sticking to the overall theme, you see that uncertainty is the worst for businesses, and in an uncertain environment, decision making is really difficult. So, at times, inaction is the best action. At times, waiting is the best action. At times, just crossing the river by just feeling the water as you do, that is the best strategy. But one thing is for sure that war in Ukraine, as the chart shows on the right hand side, you can see from the previous, from 2022 to 2023, up until the end, war in Ukraine, that element, that factor will be the significant, considerable contributor to the overall uncertainty in the markets. And of course, needless to say, this spills over into food markets, commodity markets, financial markets, and overall diplomatic ties between countries and alliances. So that's something, until or unless one of the countries win or there is a truce, a compromise, there is a chance of escalation. Hence, nothing is certain, unfortunately. Inflation. If you look at inflation has come down, of course, but core inflation is still there. Sticky inflation is sticky. Mark has spoken a lot about this in the Econ show. Most of us agree that inflation has been sticky. The transitory versus sticky debate has been over now. But these figures are tricky as well, as I continue to highlight that the fall in inflation isn't as significant. It is significant when you look at it in terms of data, but not for real people. If I'm a businessman, the cost of keeping inventory in the warehouse, the cost of doing business in a highly inflationary level, food prices for households like Pakistan, where 51% of your average income of your average household is spent on basic food items. I don't think this would be a good news for them. Or this might not even show a proper trend, a longer term trend. This might be a glitch, a blip, because the sowing season in Ukraine was wasted because of the war. And I keep wondering what will happen in the next winters when the time of the harvest of that season would come. Are we really thinking that there isn't going to be another hike in food prices? I don't think so. There will be, creating all sorts of difficulties. So, and if talking about in terms of output losses, you see that output losses have exceeded the estimates. That is why I say, IMF keeps revising their estimates. And the most pronounced losses are in emerging markets, in the low income countries. And I feel that as much as risks are out there, they're lurched, they are sort of hiding from the eyes of the policymakers trying to do that. They find their home in the emerging markets, in the low and middle income countries. Why? Because that is how you get Arab Spring. That is how you get, protests and other things. And I continue to maintain that, unfortunately, the EMDEs, emerging markets and developing economies, they might have this potential threat in them, a risk that might become a global thing, because the way things are poised right now, the way things are placed, excuse me, right now, anything can just set them off, whether it's the Chinese property sector or the fall in US housing market or some country defaults in Asia that had off about which lots of banks have exposure in the West. So that those remain tail risks. Moving forward, this was a very interesting slide, and it shows what's happening across the world. I mean, so IMF is in the news. Why? Because strong dollar, highly global monetary policy tightening, developing countries continue to suffer. Lebanon, for instance, is going to devalue its currency by 90% to get the IMF tranche. Pakistan lost around 12 to 13%. The currency depreciated 12 to 13% in one day, highest in the past 20 years. Pakistan's interest rate, 17%, stands at the 25 years high. And this is a story across the developing countries. Germany, but that it is not confined to that. Germany is on the brink of recession. And the interest rates of Germany are supposed to touch 15 years high. Similarly, in the UK is going to be the only G7 country that is going to be contracting in terms of economy this year. The mortgage rates, as we will see in the sentiment tracker, have more than doubled in UK. The mortgage, the giving, the consumer spending have slowed down. We will see in the next slide. And in the US, the factory gauge, the ISM index have fallen to the fifth lowest since May 2020. It speaks a lot about what's happening in the real economy. Although unemployment levels are really good, have touched the lowest actually, but I continue to think, and this is something that I can't reconcile between some of the indicators and what's happening in what is being told to us. So I'll dig into that next week. But one thing that is certain, that everything is not okay. It's all about perspective. What are you comparing it with? Finally, you see market sentiment tracker. The recessionary side continues to outweigh the recovery side. Mortgage approval rates in the UK have dropped to 2.5-year low because consumers are not spending. I mean, look at the energy bills there and the rents. I've speak to my friends there, and it's absolutely mad, as they say. Interest rates are hiking, of course. Spanish inflation data came out. It was worse than expected. Germany's interest rate, we've spoken about that. IMF has said that the central banks needs to stay the course, and all of these things, they show that there's still some risks, and we will see some sort of revisions in these outlooks as China open up, as LNG prices go up, as energy prices stage another rally, as Fed sort of hint that they might not be winding down their interest rate policy very soon. So that's all from today. I'll see you next Monday, but until then, I think cautious optimism continues to be the approach, and some of these indicators actually show that. Thank you so much for watching.